The Comex vaults held 346 million ounces of registered silver in March 2020. As of December 26, 2025, they hold 127 million. That is a 70% reduction in deliverable metal. In the first 4 trading days of December 2025, traders claimed 47.6 million ounces for physical delivery. That represented more than 60% of what remained in registered inventory at the time. This was not panic, it was arithmetic. While this was happening, the CME Group raised margin requirements on silver futures 3 times in the same month. The initial margin for March 2026 contracts climbed from approximately $19,000 per contract to $25,000 on December 29th. 2 days later, it went to $32,500. That is a 71% increase in capital required to hold the same position. On January 1st, 2026, China implemented export licensing controls on refined silver. Only 44 state-approved companies may now export the metal. China ships roughly 121 million ounces of silver annually to global markets. That flow now requires government permission for every ounce. On January 2nd, 2026, physical silver in Tokyo traded at approximately $130 per ounce. In Dubai, the price was reported near $95. The Comex spot price on the same day was around $71. That is a $59 premium in Tokyo, a $24 premium in Dubai for the same metal on the same day. Dealers in the United States are charging premiums of $10 to $15 per ounce over spot for physical silver coins and bars. Some products are not available at any premium. Inventories are frozen. Replacement costs exceed current retail prices. The spread between what a screen says silver costs and what it actually costs to obtain metal you can hold has never been wider in modern market history. This is not a squeeze. This is a repricing event happening in 2 separate realities. The paper price reflects the futures market. It assumes liquidity. It assumes fungibility. It assumes that a contract for 5,000 ounces of silver is equivalent to 5,000 ounces of silver. The physical price reflects delivery. It reflects transport. It reflects the fact that someone, somewhere, must produce the metal, refine it, ship it, store it, and hand it over. When those 2 prices separate by double digits, the assumption breaks. The silver market entered backwardation in October 2025. That means spot prices exceeded futures prices. Commodities do not normally behave this way. Futures are supposed to trade higher than spot because of carrying costs, storage, and interest. When the curve inverts, it signals that immediate possession is more valuable than a promise of future delivery. Silver futures remained in backwardation through December. The December 2025 contract traded below spot. So did contracts through late 2026. This is not a one-week anomaly. It is a structural condition. Backwardation in a commodity market means one thing. The physical supply available for delivery is insufficient to meet immediate demand at current prices. When this happens in crude oil, governments intervene. When it happens in wheat, strategic reserves are released. When it happens in silver, no one intervenes. There are no strategic reserves. There is no release valve. There is only the vault, and the vault is down 70%. The mechanics of the Comex system are straightforward. Silver held in approved warehouses falls into 2 categories, eligible and registered. Eligible silver is metal stored in a Comex facility that meets purity standards but is not available for delivery against futures contracts. Registered silver is metal that is available. It can be claimed. It can leave. As of late December 2025, Comex warehouses held approximately 451 million ounces of eligible silver, but only 127 million ounces were registered. Eligible does not matter when a contract comes due. Only registered counts. In the first week of December, 7,300 contracts stood for delivery. Each contract represents 5,000 ounces. That is 36.5 million ounces. In 4 trading days, the total reached 47.6 million ounces. The entire registered inventory at the start of the month was less than 80 million ounces. Do the math. By mid-December, registered inventories had been partially replenished through reclassification of eligible metal. Owners moved their silver from the not for delivery category to the for delivery category. This is not new supply. It is existing supply being unlocked by price incentives or contractual obligations. But the underlying dynamic has not changed. Delivery requests are outpacing new inflows. The vaults are not refilling from mining output or scrap recycling. They are refilling from internal reclassification. That is not a sustainable equilibrium. On December 26th, the CME raised margins again. On December 30th, they raised them a 3rd time. These were not scheduled adjustments. These were emergency interventions. Margin hikes serve one purpose: to reduce speculative leverage. Traders who cannot meet the new capital requirements must liquidate positions. Liquidation creates selling pressure. Selling pressure suppresses price. The timing is not coincidental. Silver had reached an intraday peak of $84.01 per ounce on December 29th. The margin hike was announced that same day. By December 31st, spot silver had fallen to approximately $73. This is the third time in 45 years that the CME has raised silver margins during a parabolic rally. The previous two instances occurred in 1980 and 2011. Both times, the price of silver collapsed within weeks of the hikes. The market remembers this, but the market has also changed. In 1980, the Hunt brothers were attempting to corner the silver market through leverage. The margin hikes forced their liquidation. The price fell from $50 to under $11 within months. In 2011, silver rallied from $17 to $49 in less than a year, driven by post-financial crisis monetary expansion and retail speculation. Margin hikes combined with a stronger dollar to reverse the move. Silver eventually bottomed near $14 in 2015. Both prior episodes were leverage-driven speculative bubbles. The physical market was not under stress. There were no delivery failures. The futures market functioned. This time, the delivery requests are coming from entities that intend to take possession. They are not rolling contracts forward. They are not closing positions for cash. They are demanding metal. The vaults are not delivering fast enough to prevent backwardation. That changes the equation. A margin hike can force a leveraged speculator to sell a paper contract. It cannot force a physical buyer to stop wanting metal. If the buyer has capital, they simply pay the higher margin and wait for delivery. If they do not have capital for futures, they go to the physical market. That is where the $10 to $15 premiums are coming from. The repricing is happening outside the exchange. China's export licensing regime went live on January 1st, 2026. The stated purpose is oversight. The practical effect is control. China produces roughly 3,500 metric tons of silver per year. It also refines and exports silver that originates elsewhere. Total annual exports are approximately 121 million ounces. That metal supplies manufacturers in Japan, South Korea, India, Europe, and the United States. Under the new rules, only large, state-approved companies may export. Every shipment requires a license. Licenses can be granted, delayed, or denied. This is not a ban. It is a mechanism for strategic allocation. China has done this before with rare earth elements, tungsten, and antimony. The pattern is consistent. First, restrict exports. Second, observe market response. Third, adjust supply to maximize strategic leverage. Silver is now in that framework. The United States designated silver as a critical mineral in 2025. It is essential for photovoltaics, electronics, defense systems, and battery technology. The Department of Defense uses silver in missile systems, radar, and communications infrastructure. U.S. domestic silver production is approximately 31 million ounces per year. Annual industrial consumption exceeds 200 million ounces. The difference is imported. If Chinese export licenses tighten, that gap does not close, it widens. Western buyers will bid higher for non-Chinese supply. Premiums will increase, lead times will extend. Industrial users will secure metal at any price to avoid production stoppages. That demand does not show up in Comex futures. It shows up in physical markets, in Tokyo, in Dubai, in Switzerland, and it shows up in vault withdrawals. The divergence between screen price and physical price creates two separate markets. In the paper market, silver is a commodity. It is fungible. It trades on volatility, sentiment, and macroeconomic indicators. When the Federal Reserve signals rate cuts, silver rallies. When the dollar strengthens, silver falls. This is a derivatives market. It prices expectations, not metal. In the physical market, silver is inventory. It is finite. It requires production, refining, transport, and storage. When industrial demand exceeds supply, the price adjusts. When delivery times extend, premiums appear. This is a supply chain. It prices availability, not expectations. These two markets are supposed to converge. Arbitrage is supposed to close the gap. If Comex silver trades at $71 and Tokyo silver trades at $130, an arbitrageur should buy Comex futures, take delivery, ship the metal to Tokyo, and sell it for a $59 profit. But that arbitrage is not happening. Why? 3 reasons. First, taking delivery from Comex requires capital, logistics, insurance, and time. Futures contracts settle in specific delivery months. If you miss the window, you must roll to the next contract. If registered inventory is insufficient, your delivery may be delayed or cash settled. Second, shipping silver internationally requires export licenses, customs clearance, and compliance with local regulations. If China controls export licenses and Japan is a destination market, that arbitrage depends on Chinese approval. Third, the $59 premium in Tokyo may not last. If it is temporary, the arbitrage fails. If it is structural, the arbitrage eventually closes the gap. But the gap is not closing, it is widening. That suggests the premium is not temporary. It suggests physical silver in Asia is being priced based on actual scarcity, not future sentiment. The Comex is facing a structural problem it has never fully confronted. The assumption that paper and physical are interchangeable is being tested. For decades, the futures market functioned because most contracts were closed financially. Traders bought and sold paper. Delivery was rare. The system worked because the vaults held enough metal to satisfy the small percentage of contracts that stood for delivery. If 5% of open interest demanded delivery, the system could handle it. If 10% demanded delivery, the vaults would strain but manage. If 60% of registered inventory is claimed in 4 days, the system is no longer pricing a commodity. It is pricing a bottleneck. The response from the CME was predictable. Raise margins, reduce leverage, force liquidation, stabilize the paper price, but the physical price did not respond. Tokyo is still trading at $130. Dubai is still trading at $95. US dealers are still charging 10 unicorns to $15 premiums. That tells you where the real demand is. The strategic question is not whether silver will go higher. The strategic question is whether the two markets will reconverge, and if so, which one adjusts. Does Tokyo drop to $71, or does Comex rise to $130? History suggests the physical market is the anchor. Paper prices can be manipulated through margin hikes, central bank intervention, or derivatives positioning. Physical prices reflect actual supply and demand. They reflect who is willing to mine, refine, ship, and deliver metal at a given price. If the physical market is pricing silver at $95 to $130, that is the real price. The paper market is simply late. There are three possible outcomes. First, delivery demand subsides. Buyers who stood for delivery in December receive their metal and do not return. The vaults stabilize. Registered inventories rebuild through new supply or reclassification. The paper price and physical price converge back toward equilibrium. Silver returns to $50 to $60. Premiums compress. This is the soft landing scenario. It assumes December was an anomaly, not a trend. The problem with this scenario is the supply side. Global silver mine production is roughly 830 million ounces per year. Industrial demand is approximately 560 million ounces. Investment demand adds another 240 million ounces. That is a deficit of 30 to 50 million ounces annually, depending on scrap recycling. The deficit has persisted for 5 consecutive years. It is not closing. If demand remains constant or increases due to solar panel production, electric vehicle adoption, or defense procurement, the deficit widens. That means less metal available for Comex vaults. That means delivery stress continues. Second, Comex changes the rules. Cash settlement becomes mandatory above a certain threshold of delivery requests. Contracts are settled financially, not physically. Traders receive dollars, not metal. This would prevent a vault default. It would also destroy the legitimacy of the futures market. If Comex silver futures no longer guarantee delivery, they are not pricing silver. They are pricing a derivative of silver. That derivative may trade at a discount to physical. The two markets would fully decouple. Institutional buyers would abandon Comex and move to physical markets. Liquidity would collapse. The exchange would lose its role as the global price-setting mechanism. This is the failure scenario. It is politically and financially unacceptable. Third, the paper price adjusts to the physical price. Comex silver rallies to reflect actual availability. The margin hikes fail to suppress demand. Physical buyers continue taking delivery until registered inventories approach zero. At that point, the exchange either allows default or reprices contracts to match physical premiums. Silver would trade at $90 to $130, not $71. This is the repricing scenario. It assumes the market is discovering that silver is more scarce than futures prices suggest. The evidence supports the third outcome. Registered inventories are down 70% from 2020. Delivery requests in December were at record levels. Backwardation persisted for months. China implemented export controls. Tokyo and Dubai are trading at premiums of 40 to 80% over Comex spot. These are not temporary dislocations. These are signals of structural scarcity. The margin hikes do not change the supply. They change who can afford to hold a futures position. But if physical buyers do not need futures, the margin hikes are irrelevant. They simply shift demand away from the exchange and into the spot market. That increases premiums. That increases delivery requests when buyers realize they cannot source metal elsewhere. The feedback loop is self-reinforcing. As premiums rise, more buyers attempt to source silver directly from Comex. As Comex inventories fall, backwardation deepens. As backwardation deepens, futures lose their function as forward price indicators. As that function erodes, physical markets set the price. At that point, Comex is no longer the benchmark. It is a residual liquidity pool for traders who do not care about delivery. The market has seen this before in other commodities. In 2022, nickel on the London Metal Exchange experienced a short squeeze so severe that the exchange halted trading and canceled trades retroactively. The price spiked from $29,000 per metric ton to over $100,000 in 2 days. The LME intervened because the alternative was default. Physical nickel was not available to settle contracts. Traders who were short could not deliver. The exchange chose to void trades rather than allow the market to clear at the true price. Silver is not nickel, but the mechanics of a delivery squeeze are identical. If the vaults cannot deliver, the exchange must either settle contracts in cash, halt trading, or allow the price to rise until demand falls. None of these options are neutral. The industrial users of silver are not traders. They are manufacturers. If they cannot source silver at any reasonable price, they halt production. That disrupts supply chains in solar, electronics, defense, and medical equipment. That makes silver a national security issue, not just a commodity issue. Which brings us back to China. China controls export licenses. China refines a significant portion of global silver supply. China can allocate that supply to domestic industries or withhold it from foreign buyers. If the West needs silver for defense, solar, and technology, and China controls access, that is leverage. The pricing mechanism for silver is now a geopolitical variable. When premiums in Tokyo exceed $50 per ounce over Comex, that is not a market inefficiency. That is a signal that physical silver in Asia is no longer priced in dollars. It is priced in access. Access requires approval. Approval requires relationships. Relationships require alignment. This is not speculation. This is how strategic commodities are allocated when supply is constrained. The West has three options. First, increase domestic silver production. U.S. silver output is 31 million ounces per year. There are no large undeveloped silver deposits in the United States. Increasing production requires higher prices and longer lead times. That does not solve the immediate problem. Second, secure supply agreements with non-Chinese producers. Mexico produces 190 million ounces per year. Peru produces 90 million. Both are potential partners. But their output is already committed to industrial users and refiners. Reallocating that supply requires new contracts, new refineries, and new logistics. That takes years. Third, accept higher prices and manage the transition. Let the Comex price rise to match physical premiums. Let silver trade at $90 to $130. Let industrial users pass the cost to consumers. Let the market clear. This is the most likely outcome because it requires no intervention. But it also means the assumptions that governed the silver market for 40 years are over. Silver is no longer a speculative commodity. It is a strategic material. The Comex vaults are not a buffer. They are a bottleneck. The futures market is not a pricing mechanism. It is a residual liquidity pool. The physical market is not a retail oddity. It is the real market. And the $15 premiums dealers are charging are not temporary. They are the new floor. When paper and physical decouple, trust the physical.